Hello there, Dorian Daily listeners, and welcome to the 6th episode of the Dorian Daily podcast. Our quote today comes from the father of value investing, famous economist, investor, and professor named Benjamin Graham. The quote reads, "The intelligent investor is a realist who sells to optimists and buys from pessimists." I love this quote. And I would highly recommend any of the listeners who are interested in investing in business and finance to read Benjamin Graham's seminal books. The first being The Intelligent Investor, and the second being Security Analysis, which he wrote alongside David Dodds. While some of you might not know who Benjamin Graham is, there's a good chance that you know his chief disciple, which is Warren Buffett. Warren Buffett's investing philosophy was highly influenced by Benjamin Graham's value investing approach, and it's definitely going to be worth spending an entire podcast to talk about, value investing in general. But three key metrics that Benjamin Graham looked for when deciding to invest in individual company shares were consistent revenue growth, demonstrated in the last 5 to 10 years. Price to earnings ratio, which is not that high. So for him, anything above a 20 to 25 price to earnings ratio would be considered high. And for those who don't know, the price to earnings ratio is calculated based on the market value of the share price divided by the earnings per share. And then the third thing for a solid Graham, metric in terms of what would make a solid equity would be a consistent dividend or dividend yield for shareholders. So as we spoke about in the podcast previously, many companies pay a dividend, be it quarterly or annually, and it's a terrific source of passive income for investors. And it's also a way in which the security price or the stock price decreases in volatility. So generally speaking, the big dividend paying companies that have paid dividends for a number of years, their share prices are not as volatile as those companies which don't. So for instance, like if you were to take the Benjamin Graham approach for Tesla, for example, or just like three of the key metrics, he'd love the consistent revenue growth, but he would not buy the security in any means because A, they don't have a price to earnings ratio because they're not a profitable company. And for those who don't know, the magic formula for business is revenue minus cost equals profit. So you need to be able as a business to either increase your revenues more than you increase your costs, or you need to be able to decrease your costs more than you decrease your revenues in order to generate profit. And Tesla is a non-profitable company, and Graham wouldn't touch it just based on the fact that they don't have a price to earnings ratio. And also, they don't pay a dividend, which Graham is looking for companies with consistent dividend payouts for the reasons that were just described. So, somewhat continuing on the 4th episode of the Dorian Daily podcast, we're going to continue talking about investing and various market basics. And I thought today would just be a good time just to talk about securities in general and maybe provide a little commentary on general market outlook right now. So it's interesting. I know people who do securities work on the legal side, and they're still not totally clear as to what a security is. So I think it'd be a good thing to cover. When most people think of securities, they think of stocks and bonds traded over the counter or on a market exchange. So as we've discussed previously, public corporations, they're able to live longer than their owners or their initial founders because they're able to issue securities on capital markets and exchanges. So this is generally in the form of common shares, also known as equities, and the public and institutional investors and banks, they could buy common shares of public corporations on a stock exchange. In North America, the big ones are the NASDAQ, the New York Stock Exchange, the Toronto Stock Exchange, and the Toronto Stock Venture Exchange. Generally speaking, companies do this for financial reasons. And if you take a finance course, there's a optimal debt to equity ratio that companies want to maintain depending on your specific industry or sector. But it's not fruitful for companies just to take out huge loans from banks and finance their operations solely on debt. They want to be able to raise shareholder equity, and they do this by issuing common shares in the stock market. So that's the common form of security that we think of. And also bonds. So bonds could be either government bonds, there's like municipal bonds, provincial bonds, or federal bonds, and they can also be corporate bonds. A bond is a debt security that pays a fixed amount of interest until maturity. When a bond matures, so at the expiry date, the principal amount of the bond is returned to the bondholder, and many investors calculate the present value of the bond based on 3 factors. So the first factor is the coupon rate. The coupon rate is sometimes, you can also refer to it as the interest rate. So it's paid to bondholders usually semi-annually, so once every 6 months. And it's a fixed return that the investor earns periodically until the maturation of the bond. The maturity date is the second key variable which factors into bond pricing. So all bonds have a maturity date or an expiration date. Some are short-term, others are long-term. And when the bond matures, the bond issuer repays the investor the full face value, as we just previously said. And this, depending on how long the bond is, because the interest rates for various countries, as set by the Federal Reserve or the Bank of Canada, they change over time. So that contributes to the uncertainty and the risk in which you're taking on, because they have an inverse relationship with the country's interest rate. So if the interest rate rises, say the Bank of Canada increases the interest rate, the value of the bond will generally fall. Whereas if the interest rate becomes lower, then the value of the bond will generally increase. And the current price of the bond, depending on the level of interest rate in the environment, the investor may purchase the bond at par, below par, or above par. So as we just mentioned, there's an inverse relationship between the bond value and the interest rate. So if the interest rate increases, the current price of the bond will decrease, and it can be said to be trading below par. Par means the interest rate has remained the same vis-a-vis the bond price that it was initially purchased at, or the initial coupon rate, which is fixed, by the way. And if it's trading above par, that means that the interest rate went down in the national bank, and then the value of the bond went up. So it could be said to trade above par. So municipalities, provincial governments, state governments, and nations, they all issue bonds to fund various expenditures and social programs. And then corporations, same thing, to finance their business activities, if they want to do a huge acquisition, or if they want to just general pay for day-to-day operating costs, like salaries of their employees, huge payouts to CEOs. Right now, like as an investor, it's an extremely difficult time to be in the fixed income game. So the bond game, like the yields are just so low because interest rates in Canada and the United States are at historic lows. So you're really not making any money if you have bond positions, because with the rate of inflation, as we discussed in episode 4 of the Dorian Daily podcast, if the rate of inflation is 2%, a lot of the fixed income vehicles in Canada and the US right now, you're only getting like a 2 or 3% yield. So you're really not making that much money. And it's interesting, actually, further to my episode 4 discussion on somewhat alluding to exchange traded funds being a good vehicle for a lot of investors, which is something which Warren Buffett would agree with, actually. I'm going to pull up a Warren Buffett quote here. The quote reads, "By periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals." And he's absolutely right. It's really interesting, too. I went to a discussion at my my school, I'm in an MBA program at the Schulich School of Business, which, total aside, just got ranked the top 2-year MBA program in Canada by Forbes and number 8 in the entire world. And the discussion was from one of our school's alumni, Chris Dumont, who has a new book called Kicking Financial Ass. And he had a very interesting take, which sort of, strengthens what we've been talking about on the Dorian Daily podcast. He's all in favor of exchange traded funds or index funds, just like Warren Buffett. And his position was actually, it's best just to buy fully into the S&P 500, which we've been talking about equities today. S&P 500 just tracks the top 500 companies listed on the New York Exchange. And the average return is over 8%, and by just dollar cost averaging, regardless of if it's a recession or a bull market, to keep consistently investing all of your money that you're saving into an S&P 500 fund, so like the Vanguard, like VOO, with the really low expense ratio, you're gonna beat pretty well every single mutual fund that's offered by the banks, and you're going to do a lot better than even professional investors who run their own private equity firms, because it's just so difficult for them to beat the market. But if I were to hedge slightly what Chris and Warren Buffett are saying, I'm in favor in current market conditions of being in 100% equities. Not everybody is, because you have to be able to stomach a recessionary period and being down, say, like 30% of your whole portfolio. But again, if you lost money in the 2008 recession and like you didn't sell low at that time and you just kept it in there, you would have made all your money back and then some. But a lot of people don't have the stomach for that. So they put in a few like bond positions, which are like a lot less, like the fixed income, which is a lot less volatile. And then in the time of a recession, when they need money, they just draw from the bond portion or the fixed income portion, and then just like leave your equities, because they will bounce back. You want to buy them low, or in the case of dollar cost averaging, which is when you're just buying, like, so you're buying the S&P 500 index or the TSX 60 index like every single month, like once a month, just not worrying about the market trends, consistently buying. And then if you do want to sell, try your best to wait for a boom period, and don't sell short during a recession. And in the spirit of full disclosure for my audience, like I personally am in almost 100% equities, but I don't put all my money just in the S&P 500 or the TSX 60. I try and have my positions hedged through various other forms of securities, either in the exempt market as well as buying and selling options, be it put options or call options, as well as contracts for difference, either for commodities or for equities. For example, I'm holding a position right now where I'm actually short the S&P 500. So the more the S&P 500 goes up, the more money I lose. But I think we could cover like those types of strategies as the Dorian Daily podcast progresses, because they're a little bit more like financial, like it takes a little bit more financial analysis in order to be able to understand those positions. And it is something we will work our way up to in the Dorian Daily podcast. But for now, I think we should just return to like the securities basics. So I'm going to pull up the Securities Act, the Securities and Exchange Act of 1934, in order to say more generally what are securities. So we've talked about equities, and we've talked about bonds, be they corporate or government. But there's also many more types of securities. So this is an extremely long list, but for the Securities and Exchange Act of 1934, which is a piece of U.S. legislation, the term security means any note, stock, treasury stock, bond, debenture, certificate of interest, or participation in any profit-sharing agreement or in any oil, gas, or other mineral royalty or lease, any collateral trust certificate, put, call, straddle option, or privilege on any security, certificate of deposit, GIC, index. Like it just goes on and on and on. So pretty well just like anything in the financial world can be deemed a security. And it doesn't actually have to be listed on a public exchange like the Toronto Stock Exchange or the New York Stock Exchange. Those are for the like public companies as well as governments. But there's also what's called the exempt market. It's mostly dominated by like institutional players and accredited investors. So like private companies, they're able to issue like private security placements in order to raise like share capital. For instance, I think Elon Musk's company, SpaceX, they issued a private placement to the Ontario Teachers Pension this summer. And it's like, I think it was a lot of money, like in the billions. But like even like retail investors, they're able to now participate in the exempt securities market to a certain extent. So, for example, in the province of Ontario, the Ontario Securities Commission expanded the scope of the exempt market in 2016. So various companies could raise or issue exempt market securities by way of offering memorandum or like peer-to-peer lending exemptions, various things, because public companies, to list securities, they need to have a prospectus. But offering memorandums is like a shortened prospectus. One company I've done some consulting work with is Lending Loop. So they're Canada's like first peer-to-peer lending platform. This is like a huge model that started in Britain and it went to the United States. I think in total, like peer-to-peer lending platforms in those two companies have billions and billions of dollars in sterling pounds in outstanding principal. And a lot of them are geared towards small and medium-sized enterprises that are underserved by like chartered financial banks. We'll definitely do a full podcast episode on this. In the US, they also have like peer-to-peer lending platforms, like literally just for like personal lines of credit, and people like crowdsource them. The company I'm active with in Canada is called Lending Loop. So they're catered towards like small and medium-sized enterprises. And they provide the competitive business loans vis-a-vis the big five commercial banks. And they just crowdsource the loans. I think they've raised like over 45 million total in like outstanding debt principal. And they've been able to do this through the exempt securities market. So as like an investor, you can go log on, either you're like a retail or sophisticated or accredited, and that determines how much you can spend per year in this exempt form of security. And there's a whole bunch of companies that are listed, and you can essentially lend them money to finance their business. You get like a financial statement, just a balance sheet and a cash flow statement or statement of comprehensive income. And it's in the form of like a short-term debenture. So 3 to 4 years, they pay based off a fixed amortization schedule. So principal and interest every single month until the maturation date. And that's a solid way. That's really how I engage in like the fixed income side. I don't buy bonds. I just buy short-term debentures in the exempt securities market. And it's a lot riskier because like some of them are just like mom and pop shops like that you don't actually know. Like I think I lent money to some gas station in like Surrey, British Columbia. And I've never been to British Columbia. I don't know if this gas station's any good, but I can look at the financial statements and say, okay, it looks like they have somewhat of a viable business model in terms of revenue, cost, profit. You can see it's been going up per year and they're making profit. So it's interesting. I think that's a good way to diversify your portfolio, but you don't want to be totally in that because you are taking on more unsystematic or like company specific risk, and these are companies that like no one's heard of. So, but it's in the US, like even for another example of the exempt market securities, they have this platform called Roofstock, and it's like a similar concept whereby they just like pool a bunch of investors together, and you could crowdsource like real estate investment, and they're really interesting. It's a new thing in the 21st century as like the regulators of securities are becoming increasingly open to alternative investment types beyond just like the boring old like equities and bonds, which I think it could be a little bit crowded. At least particularly the equity space could be a little bit crowded at times. So just some like interesting alternative ways to make money, and I'd highly recommend checking them out. And based on your risk portfolio, if you have to be a little bit riskier to participate in the exempt market, but it's potentially a good way to diversify your portfolio. And again, it's just consistent with what a security is. It's like a claim for some type of ownership interest or like money stream in the future from either like a business or a municipality or government, what have you. Maybe to drill the point home, I'll bring up the legal definition. So Black's Law Dictionary, which is considered like the number one like legal dictionary, says securities or stock certificates, bonds, or other evidence of a secured indebtedness or of a right created in the holder to participate in profits or asset distribution of a profit-making enterprise. More generally, written assurances for the return or payment of money or property. So when you're buying a common share, you don't necessarily get money every single like quarter or year if the company's not paying a dividend, but you do get like property in the form of a ownership stake in the company. And that's pretty cool. And we live in such an awesome time insofar as with all these like web-based platforms, no one in the history of the world has been able to participate in securities markets as expediently and as quickly and to such scale as we have today. And as an individual, it's like absolutely crucial for wealth creation that you do participate in these markets. And as we've alluded to a lot on this podcast, if you're not participating yourself, you're paying somebody else a lot of money to participate on your behalf in the form of mutual fund managers. So it's a great time to be alive. You know, even a low income person in North America today actually has a better quality of life than Cornelius Vanderbilt did when he was alive. And that was at a time the richest person in North America. I mean, you think of just having, working plumbing and air conditioning and a car and just things that we take for granted in today's life, but the richest person in the entire world just 1.5 to 2 centuries ago, they didn't even have. So it's really something to think about. And thinking about the general market outlook, as I've already alluded to, I'm a little bit bearish on the S&P 500. I think that TSX hit the all-time high multiple times this week, and S&P 500 is close to all-time highs. And it's just been a tremendous run in the last 11 years that we've had. And I don't think that, fear of a recession should keep people out of the market right now, because the longer you wait on the sidelines, the more gains or potential gains that you're missing out on right now. So while I'm personally bearish on the S&P 500 insofar as I have like a short position, that's just one of the hedged positions I have. There's a lot where I have a very bullish outlook. So maybe we'll introduce, starting episode 5 from now on, we're going to have a new segment whereby I recommend a certain stock pick. So my stock pick for today, which I personally did buy into, is Cardinal Health Incorporated. CAH is the ticker on the New York Stock Exchange. It's currently trading at about $47.90. And I think that our good friend Benjamin Graham would think this is a very good value investor pick. For those that don't know, Cardinal Health is an American multinational healthcare services company, and it's the 14th highest revenue generating company in the United States, with an annual revenue in 2018 of over $136 billion. And with aging populations in North America, the baby boomers, demand for healthcare services is increasing. And this is something that even if there is a recession, I don't want to say it's recession proof, but you can't just stop going to the doctor and hospital if the economy's not doing well, because your personal health is the most important thing. And some of the key performance metrics on this are the price to earnings ratio. So as we talked about previously, the market price for the share divided by earnings per share is 10.6, which is well below Benjamin Graham's reservation P/E ratio of about 20 to 25. And for comparison's sake, Amazon Incorporated is trading at about 75 priced earnings right now. And they've exhibited consistent revenue growth in the past 5-10 years. And their dividend yield is currently over 4%. So for those that don't know, the dividend yield is calculated based on the annual dividend divided by the market price of the share. So for Cardinal Health, it's about 4% right now. This is the highest it's been in a long time, but this company has like a proven track record of paying dividends. They do so like 3 or 4 times per year, and they're consistently between like 2 and 4%. And they've done this for over 5 years. They've paid a consistent dividend, and it's just a terrific form of passive income. Like for instance, I don't think it's going to stay as high as 4%. And if you do want like a higher, like there are higher dividend paying companies, but for instance, a 4% dividend, if you have like $1 million in common shares, which is a huge position, but if you have $1 million and they're paying a 4% dividend consistently, that's $40,000 in passive income per year, which is more money than some people live off. So it's really a great source of wealth. Although it's not guaranteed, the company doesn't have to declare a dividend. And by all means, you should, well, some people do just invest based off of companies with high dividends. It's not the be all end all necessarily, but it is one factor to consider. Anyways, I think we are done for today. I'd like to thank you so much for listening, and I hope you have a fantastic weekend. Take care.